Hello everyone, this is BHAVIK CHOKSHI here and I hope you guys are doing great. Today we would be doing a quick revision for joint ventures, operations and associates. In case you want to also refer the subsidiary based revision video, you can see the link that we've shared at the top. Okay, so let's get started. Now the legal framework for joint ventures, joint operations are given under a standard IND 111 and then IND 28 governs associates. So before we proceed into associates, we first try to understand what do you mean by a joint arrangement. A joint arrangement is something which needs to have joint control. Now for joint control there are two essential features. One, there is collective control. Collective control means that the control is shared. So I don't have the ability to direct the relevant activities unilaterally at my choice, but without my consent the activities cannot be directed. So over here the control is collective and unanimous. It means that without the approval of a partner, the decision on relevant activity cannot be taken, but merely because a partner is approving, the decision also cannot be taken, and hence the control is shared, the control is joint, the control is common. Over here you also need to check for how the arrangement is entered into, and the law is very flexible. The heading is not joint contract, it is joint arrangement. So these agreements can be oral, written, formal, even informal, as long as you can show that they were applicable in practice. So in certain cases cartels etc., which might have an informal arrangement, they can also be within the joint arrangement heading if the respective elements of the standard are applicable. Okay, sometimes it might happen that control is implied. You don't even have a separate contract which evidences that. However, you have a 50-50 stake, in which case you have joint control. There is no other possibility other than both the partners voting together for a decision on relevant activity to be taken. Or maybe articles of association sometimes may stipulate a fairly high voting percentage, maybe 75% for decisions to be taken, in which case a partner might have 51% stake, another partner might have 30% stake, and someone else might have a 19% stake. The only way in which decisions can be taken is a single combination, that is partner 1 and partner 2 voting together, that is 51 plus 30, that is 81%. So that is the only way in which 75 can be crossed. The minimum voting percent can be attained by only one combination, in which case there is implied joint control. Okay, so further, if you look at joint operation and joint venture, now once you understand what is a joint arrangement, a further subclassification of a joint arrangement can be joint operation, in which case there is actually no separate legal entity in the middle. So for example, if two partners are coming together and buying directly a property like a house, for example, assuming it's a business, in which case the property is in the name of the partners. So there is a house worth, let's say 10 crores, and two partners come together and have direct interest in the house. There's no entity in the middle, in which case that is a joint operation always. Alternatively, there can also be a joint venture, in which case typically there's an entity in the middle. So if these two partners come together, they put in money inside a company and that company buys a house. That is a case of a joint venture where they have investment in a separate entity which legally owns the house, and hence that is a joint venture. Why are we segregating it? Because typically joint arrangement is going to be accounted for using the proportionate consolidation method, where proportionately assets, proportionate liabilities, proportionate incomes, proportionate expenses will be shown, whereas in case of a joint venture we will show the investment only, because really the assets are assets of a company and you don't control the company. By the way, you jointly control, but you don't control the company, and hence you will have to show it as an investment. This investment may be measured in a special way called as equity method, but nevertheless it will be shown as an investment. So the thumb rule is, if there's a separate entity through which you are holding the assets liabilities, in which case it's a joint venture. If there's no separate entity in the middle, it is a joint operation. In certain cases there may be entity in the middle, however the partners have a direct interest in the assets and liabilities. For example, there's a partnership, a general partnership, not limited liability, general partnership, in which case there may be entity in the middle where two partners have put in money. However, the assets and liabilities of partnership are assets and liabilities of the partners. Partners continue to be jointly and severally liable, and hence even if there's a partnership firm in the middle, the partners are directly exposed to the assets and liabilities, and hence in such cases you will have a joint operation even if there's a partnership firm in the middle. So in case there is a direct interest that the partners have in the assets and liabilities, in such a case it will be treated, let us say, as a joint operation, even if there's a separate entity in the middle. In all other cases, you can typically have a thumb rule which decides that a joint operation will not have an entity in the middle, whereas a joint venture will have an entity in the middle. The purpose of doing this is joint operation is going to be accounted for using the proportionate method, whereas the joint venture is going to be accounted for using the equity method. Now, what do you mean by associates? And associates are covered under IND AS 28. IND AS 28 is a standard which defines associates, and for associates you need to have significant influence. When does significant influence arise? When typically you have the ability to participate in policy making, financial and operating policies of an entity. You have the ability to participate, you have representation on the board, you have your managerial personnel who are represented. That is when we say that there is a significant influence. If the question remains silent, significant influence is assumed to exist if you have equal to or more than 20% stake in the company, in which case there's a significant influence. But remember, this stake is not mandatory. Even at a lesser than 20% stake, if you are participating in policy making processes, then you can be considered to have significant influence, and vice versa. How do you account for investments in associates or joint ventures? They are accounted for using a method called as equity method. What does the equity method mean and why is it necessary? Well, typically investments in associates and joint ventures are like business investments. Like when Honda invested in Hero Honda earlier, Honda was investing in a motorbike business in India. It was not just merely a financial investment where it was tracking the fair value, and hence to show these investments using fair value, whether FVTPL or FVOCI may not be the most appropriate, because Honda was not interested in selling the moment the market price of Hero Honda is high. No, it was not a financial investment, it was a business investment. And how do you gauge business investments? With how good the business works, how much profit it generates. Like for a particular company, we don't look at the market cap when we prepare books of accounts. We look at the net worth. We say share capital, and why should it increase? Well, due to every year profits, retained earnings, your equity balance increases due to profits, due to revaluations, etc. And hence the increase in the worth of your investment will not just be dependent on the market price, because you're not interested in selling it. It's a business investment, joint venture or associate. It will actually depend on how much profit, net worth, reserves the company is building in, and hence the equity method says that the investment will be measured based on the investor's share in the equity meaning share capital as well as other equity of the associate or the joint venture. So in a subsidiary, you take over assets and liabilities of the subsidiary and you eliminate the investment. In case of an associate or joint venture, assets and liabilities will not be taken over. In fact, you will continue to show the investment, which makes you understand that if assets and liabilities are not taken over, investment is not eliminated, you cannot show goodwill as a separate line item in the balance sheet. However, equity method requires you to disclose goodwill along with the investment. So it will just be a disclosure like cost of investment, let's say 120 rupees into bracket including goodwill of, let us say, 20 rupees. You will not show goodwill as a separate line item in the non-current assets in the balance sheet, but you will merely identify and disclose it. Secondly, once you have recorded the investment at, let us say, 120, you have invested 30% stake in a company, then why should this investment change? Well, it will change if the associate's equity changes after the investment. And why should the associate's equity change? Well, post acquisition, associate might earn a profit of 50 rupees. Of the 50 rupees, whether it is distributed or not, 30% is attributable to us. Typically, we don't recognize it because it's a financial investment. We don't do anything. We don't contribute anything to the company. However, here we are in all likelihood participating in the policy making processes of the other company. And as a result, if we are participating in the policy making processes, we are spending our time, effort, resources. Whether the money is distributed or not, we don't really care. We will recognize the income of 50 into 30%, that is 1515. What will be the entry? The money is not distributed. So we will credit the consolidated retained earnings with the debit going to the investment. We are saying that we have made an investment of 120 after acquisition. This investment fetched 50 rupees, out of which 30% is our share, that is 15, and hence we debit the investment by 15, credit the consolidated P&L by 15. Apart from this, there may be also changes in other reserves, like associate might have made investment in other company's shares, or it might have fixed assets which it is showing using the fair value or revaluation model, in which case there can be changes in reserves like revaluation, like fair value reserve or any other reserves. Remember, you also have a share in every item which is there in the equity, not just retained earnings, and hence if there's a revaluation in the books of the associate, or if there is even a loss, foreign currency translation loss in the books of the associate or joint venture, we will take our share of loss. Where will the second effect go? Well, the second effect will always be going against the investment. So if there is a 20 rupees revaluation in the books of the associate, your net worth or equity increases by 20, 30% of 20, that is 6 rupees is our share. Your entry will be investment account debit 6 rupees to consolidated revaluation as a part of other comprehensive income, 6 rupees. This will be done for each element inside the equity / other equity. However, sometimes what might happen is the associate might distribute dividend. If the associate distributes dividend in the SFS, you will record the investment income in the form of dividend, bank account debit to dividend income, because in the SFS, the investment continues to appear at cost as per Ind AS 27, or there's an option to show it at fair value in the SFS. However, in the CFS, you have to follow the equity method only, in which case in the SFS you will be showing income. That is because your investment was continued to be shown at 120 only. However, if you follow the equity method, then 50 rupees into 30%, that is 15, you would have shown as investment, shown as investment and credited the PNL. Subsequently, if out of that 50, let us say 40 is distributed as dividend, we receive 40 into 30%, that is 12. Now this 12 rupees, your entry will be bank account debit. Typically, should you credit the consolidated PNL? The answer is no, because the credit for the same has already gone. Then what do you credit? Well, this is treated as recovery of investment and you will credit the investment. So we say that your investment was shown as 120 plus 15. Now out of that 135, 12 is recovered and hence you will subtract 12, similar to what you do in amortized cost tables, where you add the effective interest and then reduce the coupon or the principal repayment. So over here as well, you will reduce dividend, whether it is paid out of pre or post acquisition profits. So the general rule number 1, no assets and liabilities taken over. Rule number 2, your share in the equity balances of the associate will be taken over. Rule number 3, dividend will be treated as recovery of investment and hence will be your share of dividend will be reduced from the investment. You will not again give an effect for the same in the PNL. Next, what about goodwill? Well, goodwill is to be separately identified, not to be separately shown in the balance sheet. It will just be identified as a part of a disclosure. Now, what about certain common consolidation adjustments, like for example, intercompany debtors, creditors? Let us say in the books of the investor, the associate is a debtor. In the books of the associate, the investor is a creditor. Will we eliminate that? The answer is no, because you don't take over assets and liabilities. Over here, the associate is a separate legal entity. It is not like parent and subsidiary treated as one, and hence you are showing investment in associate as a separate line item. Associate is a separate legal entity. In parent and subsidiary, they are treated as one. In this case, what we will do is we will not touch the intercompany debtors and creditors, because, well, I have a debtor, but the creditor of the other company is not taken over. So against what will I eliminate, and why should I eliminate? Because this is a separate entity, payable to a separate entity, just that the investment is measured using a different base. Then what about unrealized profits on upstream or downstream? Remember, unrealized profits have to be eliminated. In case of subsidiary, unrealized profits are eliminated in full, because, well, you take over the subsidiary's assets and liabilities in full. A part of those assets and liabilities go to the NCI. In case of associates, you do not take over the assets and liabilities of the associate. However, we do take over the profits of the associate. And as a result, we will eliminate our share in the unrealized profits of the associate. As per the most recent institute's materials, you will, in case of an upstream transaction, eliminate your share of the unrealized profit. So let us say unrealized profit is 20 and you have a 30% stake. So 20 into 30%, that is 6 rupees, will be debited against the consolidated PNL. The second effect going against the inventories in case of upstream transaction, because in case of upstream, the inventory is appearing in the books of the parent. Associate has sold to the parent, parent's inventory will appear, and hence you will remove from the parent's inventory. Whereas if it is downstream, then you will reduce it from the investment, because associate's inventory is not appearing and hence the value of that is embedded inside the investment, so you reduce it from the part of investment. You do this adjustment for both upstream as well as downstream transactions. Lastly, if there are losses, you will allocate your share of the losses of investment to the associates to the extent it becomes zero. After it becomes zero, you will typically not allocate any share in losses unless there are other long-term interests like irredeemable preference shares or long-term loans with no settlement terms. If there are other long-term interests for which we have a separate discussion and a separate video, you can allocate losses beyond. Otherwise, you will restrict your investment to a zero balance. So these are the core features. So that takes care of the equity method, and next we will discuss about the long-term interest in associate or joint venture. Now this is a very specific section which is applicable in one particular scenario, that in case you have losses in case of an associate and the share in losses exceeds beyond your investment becoming zero. In such cases, in rare cases, if you have other long-term interests like irredeemable preference shares or long-term loans where settlement is not planned, in which case there is an allocation mechanism which is provided to share those losses and the reversal of those losses, if any. For this, we have a separate video which you can refer separately on loss-making associates and long-term interests. I'll share the link for the same. So that is on a specific case. If you understand the technical issue, well and good. Otherwise, it is not going to come in a general associate or joint venture question. So this is a theory pertaining to that. And lastly, there are certain exceptions in the following the equity method. So remember, when you are preparing CFS, preparing equity method is mandatory. However, if you are an investment entity, loosely speaking, something similar to a mutual fund or a venture capital fund, you might have various investments, and as a result, the standard gives the choice to an investment entity which either directly or indirectly makes investment in an associate to follow either FVTPL, fair value through profit and loss, or to follow the equity method. The reason behind this is, for an investment entity, in a lot of cases, the investment is not really a business investment, it is more of a financial investment, and hence they track the fair value. So giving a choice of fair value will be adequate, similar to the choice even given for subsidiaries, and hence you can follow FVTPL or you can follow the equity method. We need to remember that this can be done by an investment which is either direct or indirect. So even if I indirectly invest, that is, I have 20% stake or in a company. So let's say there is Reliance Industries Limited. It has invested, it has a wholly owned subsidiary, let us say Reliance Mutual Fund, which is an investment entity, and this mutual fund invests in, let us say, another company. So since Reliance Industries is investing through an investment entity, we will be able to claim the exemption and follow FVTPL accounting and not follow equity method in case of an investment which is made either directly, if I am an investment entity, or indirectly, that is, I invest in a subsidiary which is an investment entity, and that entity invests in an associate. So even the choice is available over there. So this kind of gives you a brief overview of the joint ventures and associate section. I hope this has been helpful. I'll see you in the next video. Please do like and share if you like the video, and comment if you have any suggestions or any other concepts that you want to get covered. Goodbye and see you soon. Bye-bye.